if you have a retirement account, chances are you've seen it take a hit, unfortunately. So what do? Do you wait it out? Do you write it off? Joining us this morning with some strategies, Marshall Clay with the Welch Group. Good to see you, Marshall.
Good morning, Mike. How are you?
Doing well. All right, so let's start with that. So what are our strategies? What should we be thinking about doing right now?
Yeah, so a lot of people right now are really struggling with their budgets. I just saw your last segment with Luis Toro, and I've had hundreds of calls in the last couple of weeks, with clients that are looking to cut down budgets, really just trying to do anything to save any sort of money. And so this morning, that's what we're going to talk about. We're really focused on realizing tax losses. And so, the biggest thing to think about when you're doing that is, a lot of people right now, have stock and bond positions that are currently trading at an unrealized loss. So the key here is to turn those unrealized losses into realized losses, and that allows you to do a couple to either counteract some gains that maybe you realized earlier in the year, hopefully maybe realized later on in the year, or if you can't do that, you're able to deduct some of those losses against your taxes.
So if you sell them now, you'll get a loss, but then you can deduct that from your taxes, so it gives you a little bit of a break. And a lot of times investors will do that anyway, right?
Yeah, they do. And so, the first thing they'll do is they'll counteract any gains that they have, and the limit on deducting against your taxes is $3,000 a year. So let's just say that you realize $10,000 in taxable losses in a taxable account. You're only able to deduct those or to deduct $3,000 against your taxes in any one year.
Gotcha.
But you can carry those losses over to successive years, so you can exhaust those losses at some point.
All right, real quickly, you talk about mitigating risk. Couple of strategies. Move your money to another individual company. Let's talk about that real quick.
Yeah, so there's some timing risk and risk associated with moving out of an individual company. So if your intent is to hold on to a particular position, what you want to do is in the meantime, in the 31-day period that you have to keep those individual positions sold, you want to move into another individual stock position or bond position that's similar in attributes, or an exchange traded fund that's in the same sector. With these really volatile markets, if you sell an individual position, the next day the stock position could spike 5 or 10% and make the losses sort of irrelevant. So you want to maintain your positioning, but also make sure that you wait that 31-day period, because if you don't do that, the IRS sort of extinguishes those losses and you can't use them.
All right, good information this morning. Marshall Clay from the Welch Group. Appreciate it, brother.
I appreciate you.
All right, right now we need to take it down.